Welcome back to the channel. Today we're diving into the world of investments to compare ETFs and mutual funds. Whether you're just starting out on your investment journey or you're a seasoned pro, choosing the right investment vehicle is crucial. We'll break down the jargon, explore the pros and cons, and equip you to make informed decisions for your financial future. Let's get started. Let's break down exchange-traded funds, or ETFs. Imagine a basket, but instead of fruit, it's filled with different assets like stocks or bonds. That's essentially what an ETF is, a basket of investments you buy and sell like a single stock on the stock market. Now picture this, you want to invest in the tech industry, but you don't want to research and buy stock in dozens of individual companies. An ETF focused on the tech sector lets you gain exposure to the entire industry with just one purchase. One of my favorite income-oriented tech ETFs is Harvest Tech Achievers, an ETF that holds 20 large-cap tech stocks and pays monthly distributions. That's the beauty of diversification, and ETFs are all about it. They spread your risk across multiple assets, which can be a smart move for long-term growth. Plus, because ETFs are traded on exchanges, you can buy and sell them throughout the trading day, just like individual stocks. This gives you flexibility and control over your investments. Now let's switch gears and talk about mutual funds. Think of a mutual fund as a big pool of money contributed by many investors. This pool is then used to buy a diversified portfolio of stocks, bonds, or other assets. Here's the thing. With mutual funds, you're relying on a fund manager to make investment decisions on your behalf. They decide what to buy and sell within the fund's portfolio, aiming to achieve the fund's stated objectives. This can be a good thing if you prefer a hands-off approach to investing. You're essentially hiring a professional to manage your money. Keep in mind that mutual funds are typically bought and sold through brokerage firms, as well as the fees on these funds tend to be high, and their prices are calculated only once per day at the end of the trading day. Now that we've covered the basics of ETFs and mutual funds, you might be thinking that these two sound pretty similar. And you know what? You're not wrong. Both ETFs and mutual funds offer a way for investors to diversify their portfolios without having to buy dozens or even hundreds of individual securities. This diversification helps to spread risk, which is a key principle of smart investing. Another key similarity is that both ETFs and mutual funds are regulated by the SEC. This provides investors with a level of protection and oversight. Whether you're opting for the passive approach of ETFs or the active management of mutual funds, you can be confident that you're investing within a regulated framework. While ETFs and mutual funds share some similarities, there are some key differences that set them apart. Let's start with trading. Remember how ETFs trade like stocks throughout the day? Well, mutual funds are different. You can only buy or sell mutual fund shares at the end of the trading day, based on their calculated net asset value or NAV. This means you won't know the exact price you're paying or receiving until after the market closes. Next up, let's talk about costs. ETFs tend to have lower expense ratios compared to mutual funds. The expense ratio is the annual fee you pay to cover the costs of running the fund. Over time, those lower fees can really add up and make a difference in your overall returns. Finally, we need to talk about taxes. ETFs are often more tax efficient than mutual funds. This is because of the way they are structured and how they handle capital gains distributions. This tax efficiency can help you keep more of your investment profits in your pocket. So, we've covered a lot of ground, and you might be wondering, which one is better for growing my wealth, ETFs or mutual funds? Honestly, there's no one-size-fits-all answer. The best choice for you depends on your individual circumstances, investment goals, and risk tolerance. If you're someone who prefers a hands-off approach, a mutual fund with a professional manager might be a good fit. But if you're more of a DIY investor who likes to have more control over your investments, possibly save on fees and taxes, then ETFs could be the way to go. Ultimately, the key to growing your wealth is to invest consistently over the long term and to make informed decisions based on your own financial situation. Don't be afraid to do your research, compare different options, study the market. The most important thing is to take action and start building your investment portfolio today. If you found this video helpful, make sure to like, subscribe, and hit the notification bell for more investment tips and insights. Remember guys, building wealth takes time and effort, but with the right knowledge and strategies, you can achieve your financial goals. Whether you choose ETFs, mutual funds, real estate, or crypto, the most important thing is to stay informed and keep investing consistently in your future. Remember, financial freedom equals real freedom. See you in the next video.